Hi, everyone, and welcome to Behind the Numbers with Dave Bookbinder. This is the show that goes beyond the data to explore the people, the stories, and the insights that really drive business success. I am Dave Bookbinder, and I am known as a business valuation expert and best-selling author, and I thank you for joining me. Gang, I learned recently that there are more companies to invest in than there are investors available to make those investments. Today's guest is trying to help level that playing field. She is Karen Rands. She is president of Cougar Capital Holdings. She's also a podcast host of the Compassionate Capitalist Show. She's also the author of two books, Inside Secrets to Angel Investing. There's more to that title, but we'll just leave it at that. And her second release is a Amazon debut as a top release. It is Inside Secrets to Crowdfunding Investing. Karen, it's a mouthful. Welcome to Behind the Numbers.
Great to be here, Dave. Thank you. Looking forward to it.
Yeah, good stuff. Tell the audience the rest of the story about who you are and maybe a little bit about the books as well.
Okay, sure. So I discovered the world of angel investing almost by happenstance when I left my corporate gig at IBM to go help one of my clients raise capital and, bring this incredible piece of software that could save lives, all those good things to market. And I got invited to this angel investor event, and I went to sort of scope it out to see if it was a place for us to present, and discovered the world of the sharks, if you will, that pick and choose who gets to be the next big thing, right? Because capital it's very, very, very difficult for high growth companies to launch and grow and scale without outside capital. And to get the product to market, to generate the revenue, to bridge the gap until more revenue comes in. And I discovered this whole world. I was stunned that I had not heard of it, because I was in my job at IBM. I'd been deep into the mix of venture capital and getting capital for companies, things like that. And over the course of the next 20 years, I ran that angel investor group, rebuilt it to be one of the top in the country and one of the top in the Southeast, most active in the Southeast. And discovered all along the way that part of the big challenge is that sometimes companies didn't miss out. They didn't get the capital that they needed, didn't get to market. It wasn't because they weren't good. It wasn't because they didn't solve a problem, that they didn't have a team or anything like that. There was simply not enough capital out there. And so it was always something really frustrating with me, because, for anybody that's raised capital that's in your audience, or people that are part of an angel group, perhaps, or have invested in companies, part of the process behind the scenes, and you don't really know this about Shark Tank, but you kind of would guess that it might be, but it's the same thing when you have events that angel investor groups, you can't manage and present all the companies that are qualified to present. You have to narrow it down based on your audience and who you think they're going to enjoy seeing. Who do you think has the best odds of getting money? But it didn't mean that the two that didn't get in the door weren't good. They just weren't a fit, right? And so, when you have a scarcity of capital, it's like, where do they go? All that changed and started to change in 2012 with the Jobs Act, which was the reason I wrote part of the response to that. And for your audience that doesn't know, the Jobs Act is what legalized equity-based crowdfunding in the four different flavors that it's available. And really, there's this big mouthful of term called the democratization of the capital markets. And it meant that on both sides of the table, entrepreneurs now had a way in our digital economy to reach out to investors that weren't just in these narrow gauntlets of angel groups. So in theory, be able to get access to more capital, because there were different, and there wasn't a limitation of people to invest in it like there had been before. And so more people could create wealth this way. And so that set me on the trajectory to write the first book, which is a deep how-to. And then over time, realizing that there was a whole audience that were not accredited or not wealthy enough to be part of the angel community, but still had the ability to create wealth this way. They just had no idea they had the ability to do it. And of course, had no idea how to do it. So the second book, Inside Secrets to Crowdfund Investing, follow Jane's journey, see how a new generation creates wealth or builds wealth with purpose, passion, and profit, is a much easier read. It's a story-based how-to intended to be inspirational and hopeful for those women, people of color, millennials, anybody that felt like they have been sort of left out of the wealth game, and help them believe that they have the ability to bridge the wealth gap. And so that's a 25 years in not 25 seconds, but
Well, thank you for sharing that backstory. Let's talk about the term compassionate capitalism. It's a little provocative, but how do you define it, and how is it different from we'll call traditional venture capital or angel investing?
well, actually, so I came up with that term. It was not, I mean, I had heard it from a different context, but ended up adopting it as sort of my branding. It was on my cards, all that stuff from the very beginning. After I met one of these elusive angel investors at an event, and I said, like, how did you get started becoming an angel investor? And he told me, well, I came into some money. I think he had like a golden parachute or something. And he said, somebody invited me to one of these meetings. I thought it was kind of cool. I started investing, lost money on my first 3 deals, and then I started to figure it out. And I thought, that is a horrible way to learn how to invest, learn by losing. And, the average check of a real angel investor is about 25K on the national average. So you're saying like $75,000, $100,000 somebody loses before they figure this stuff out. And I started to understand that an angel investor, those that are committed to building a portfolio of investments, of helping entrepreneurs that are doing something that they think is really novel, that can have an impact on the world, they are compassionate capitalists because they do it to make money. That's capitalism. Capitalism is sort of the heartbeat of the United States of America. To me, capitalism is the necessary part of an economy that makes you have better products, that makes people want to have happy customers, that makes people want, because in order to buy and sell more, right? And you have to do all those things. You have to be better at it. And then the other person or the other guy, and it also gives hope for people to be able to, why we have the entrepreneur culture that we have, is that we have the ability to strive. And that really only happens in a capitalist society. But the compassion side came from the fact that they chose to put their money into companies that were doing something, solving a problem that they were passionate about. So company passion, right? I mean, I used to have a really long definition of those that invest in entrepreneur endeavors to bring innovation to the market, create jobs, and create wealth for all those involved. And I had to boil that down to, being passionate about the companies they are, because, all investments are transactions, except for angel investing and then now crowdfund investing, because that's where your money gets to put to work and has an opportunity to amplify the effect that it has. Because if you help a company succeed and you succeed with them, then there is greater wealth to go around. There is better products. There is, opportunity that we don't have otherwise.
Yeah. And when you talk about purpose, passion, and profit, how do you evaluate those in terms of, relative to maybe other financial and non-financial metrics?
Well, so the profit's pretty straightforward, right? The idea of profit when it comes to angel investing and crowdfund investing is that you bought the shares for one price, and they gained in value over time, just like people think of in the stock market. The difference is when you're investing in a private company, they're all like, the reason why they're raising capital is to put it to work, to be able to do something with it that grows the value of their company. And so if they do what they're supposed to do with the money, then they will grow, and then you will make profit on it, right? So, and then the purpose of passion is passion is kind of what I talked about, right? You're investing in things that you are passionate about, or companies that are doing something you're passionate about and they're passionate about. And entrepreneurs are always the most passionate about what they're doing, right? So you're just really giving them the fuel to be able to do it. And the purpose says, I'm making a decision to invest this way, and I'm going to be sensible, in building a portfolio. You just can't do one and done, or sort of in the industry where like people go, I did 3, like my example of the compassionate capitalist, and then I'm gonna see how it works out. Well, you can't do that. You have to have an intention of building a portfolio. I teach that in the course that's part of the bigger picture of these books. These books are the top end of that. But the Angel Profitability Blueprint is, and what Jane goes through in her journey in the book is to, how does she go about creating this portfolio, and where there's income producing and the diversity of industry and stage and type of offering, so that she builds a balanced portfolio with specific intent, with purpose, that fulfills her the passion that she has to solve these problems, but ensures that she makes profit along.
Yeah, that's a great equation. Love that. So, Karen, in my world as a valuation consultant, I work with a lot of business owners and entrepreneurs. And one of the biggest mistakes I see, because it's what I do for a living, is in the valuation. I've had entrepreneurs come to me and tell me, you know what, I can go into this pitch without a valuation. And they come back to me and they say, man, it blew up on the launch pad when the angel investor asked me, how do I justify my valuation? And they're like, just living an episode of Shark Tank. Your valuation is insane. You're dead to me. What are some of the mistakes that you see entrepreneurs make when they're seeking growth capital?
Well, yeah. 20 years of working with companies on, so and I tease in that entrepreneurs are, because of the sort of the nature of, I'm going to invent this thing that's going to solve a problem in the world and all that kind of stuff, they're very optimistic. And sometimes their optimism shades their realism. Part of the reason why they make the mistakes they make when it comes to valuation, and I know your audience probably listens. Look at that, I'm an angel. Yeah, I don't quite know. I guess it's the reason why they make that mistake is because it's so hard to raise capital that they think that they're going to. Let's see if I can. It's not working. Nothing's changing, and I'm just an angel today. They think that they don't want to raise a lot of capital. So they don't want to go through the stages that you need to raise capital that increases the value as you go. And so they'll raise too much too soon. And in order to not give up all the company, they have to create this inflated valuation. And they make this mistake of doing they don't really know how they're going to generate the revenue. So they do a percentage of, right? And then it compounds, and they don't plan for the difference. Every company has a different business model of how they generate revenue. And there's always a seasonality to it. There's always, you're bringing out a new product and you have these lags, these ebbs and flows and things like that. And they don't really understand their market well enough. So they go off of, if I just have 0.5% of this giant market, therefore I'm going to have this big company, and therefore my value is like this. They don't do a discounted present value. They don't do something that looks at, market comps, anything that sort of startups have to do, because they don't have the traditional EBITDA and all that other kind of stuff that they need, that, private other types of valuations are based on. And so it's because they have a disconnect. They don't understand how to create a financial stack. They don't understand what a cap table, how to design a cap table that's going to take them through the different phases of capital and the value and the growth and the value of their stock. And they have a scarcity mentality that they want to control. And they feel like the only way they can control it is to have 60%, 70% of their company, rather than just be the one largest shareholder, and how boards work. They just don't understand. And even though there's all these entrepreneur support organizations out there and universities and stuff like that, it's something that seems to get lost in the shuffle, that it is probably that, and some of the terms in a prescription agreement or private placement memorandum, that's the number one reason why angel investors walk away, is because of miscalculations and valuations. And the friends, family, and fool that oftentimes is the seed and pre-seed, they're investing a lot times on emotion, like doctor. I give the example that doctors are notoriously for investing poorly in overvalued companies, because they love whatever this entrepreneur, they're solving that problem, I need this so much in the operating room, or I need this. And they don't really think through, what is it going to take to raise the next round of capital, and what does that valuation need to look like, and getting all the way to the point that an exit's going to be. They just jump in because they love it, right? They're an emotional investor. They subjectively do this without thinking that at some point you got to raise capital from objective investors that are looking at 5 different deals, and they calculate in their head based on the valuation, which one am I going to likely make the most money on? That's the capital side. And then they put their money to work on the problem that they enjoy solving.
Yeah, so much good stuff in there. When you talked about entrepreneurs and their optimism, I see that all the time, and it makes perfect sense, right? It's their baby, it's their business, and they believe it's going to the moon. But you hit on two things. One, when you talk about the discounted present value thing, if an entrepreneur is working with me in a forecast, a lot of times they get what we call the hockey stick forecast, and you know what that's all about, where they're chugging along at a slow growth rate historically, and all of a sudden we're going to present a forecast that just takes them to the moon with no basis, no underpinnings. So when you talk about the different metrics that you just referred to, and the EBITDA multiples are one of them, discounted cash flow, and ways of thinking about value, what are some of the, well, I'll say, underutilized metrics that angel investors aren't really focusing on?
So and let's just put, like, angel investors are humans, okay? And so they're subject to the same sort of groupthink that other people will have. They're also subject to, I have made the mistake myself of investing based on emotion. They all have a hidden checklist of never do that again, kind of a thing, right? And so I think one of the things that they'll get caught up in the hype of whatever the person is solving, the founder is solving. I mean, you see that right now. They're talking about it with AI solutions, right? And AI companies. And now we're going to have another bubble. It's the AI bubble. And it's part of that. They're chasing the win, right? In some cases, the groupthink is that they'll jump in on a deal because there's an investor or a group, and this one's starting to raise capital, and they think this is the one that's going to, excel, right? And because it's got momentum, they start to not, like, do their own sort of common sense on that. And this idea of unicorn, right? So we've kind of hit the unicorn bubble in a way, because I have said, when they first started having that, and the definition of your audience doesn't know, the unicorn concept came, and I don't have it on the top of my head, the VC that came up with that, but said, I never thought I'd see a valuation of a private company of $1 billion, and like I would see a unicorn, something along those lines. Like, you never thought it would be, a private company to do that. So what ends up happening, and this is where it gets really messed up, is that valuation at the very beginning is really tricky because you don't have the data points to be able to calculate it. So you have to do sort of this hybrid. I tell companies, when you're at the very beginning, you have to just defend what your valuation is. And that is a combination of your future opportunity, but your current value based on what you're raising capital for. So if you're raising $2 million, 10 million is going to be in that ballpark. So how it's sort of a psychological thing that says, because I'm going to give up 20% because I know I'm going to raise 10 million the next time. And then I know I'm going to raise, and what are you going to do with that $2 million? It's going to make your business go from 10 million to 20 million. Right. And, along those lines, or 25 million. And then you've got to have real numbers in order to justify the next one. But every time there's a round of capital, it gets added to the value. And so a company that raises 2 million on a $10 million valuation is now a $12 million company. And so when VCs come in and they start putting big dollars in, $100 million, it's $100 million is added to the valuation without actually having the numbers to support it, because they're not yet generating any of that kind of revenue. So the $1 billion companies become $1 billion valuation companies because of all the money that's been put in them, a lot of times without, like, just look at Snapchat, right? Even look at, a lot of these social media companies that have huge valuations, but they had no real revenue model. Right? They had a lot of eyeballs and a lot of users, and then they struggled to figure out how to generate revenue. Uber was way ahead of themselves and just bleeding money, right? Because they're trying to buy their marketplaces, and then all these big tech companies. And so they struggle to get to an exit, because who can buy a multi-billion dollar valuation company? And going public, if the stock market price can't support that value, then it drops immediately. So you see a lot of the tech companies that went IPO, they immediately drop in value after they go public. And it's because they can't sustain. So there's being market corrections on that idea. VCs are holding, we don't have a lot of companies going public compared to prior periods of time. And you could say it's because of the turmoil of the stock market, but it's really because they have gotten ahead of themselves with these multi-billion-dollar valuations that the business model can't support it. So, common sense and math eventually gets into the equation, right? And of like, what is this company really worth besides all the money that was put into it?
Yeah, you're talking about the difference between pre-money and post-money valuation. And
Right.
I've been around long enough that I remember working with clients during the dot-com era. And again, it was a whole new world. It was the Wild West of different metrics and valuation. And what history has proven over time is that at the end of the day, cash flow matters. So if you can't find a path to profitability, the business isn't going to be worth whatever you think the valuation is. And we spent a lot of time here so far talking about mostly, I think, from the entrepreneur's lens. Let me flip the script a little bit and let's talk a little about the investor lens. And what do you think the barriers are for everyday investors who are trying to get into this space, who are looking at these opportunities and trying to find the next unicorn?
Thank you for that question. The barriers are, well, the U.S. Treasury and the SEC separately commissioned reports. One was University Research did it, the U.S. Treasury, and then the SEC did it through their council of folks that come quarterly to give them feedback on what's going on in the marketplace. And in both cases last year, they found the reason why we don't have enough angel investors out there for all the companies, and it's literally, for, a couple of numbers. University of New Hampshire Venture Capital Research and the Angel Capital Association both track that they on in angel groups, okay, in angel networks. And there's about both of them a little bit different number, but it's right around the 350,000 mark of number of angels and angel groups in the United States last year. And then at the time, one of the think tanks that follows, it might have been King's Crowd, there were about 350,000 people on the Reg CF portals, right? That's the easiest entree for your audience that doesn't know. Let me just real quick explain what the four categories of crowdfunding are. So Reg CF is the one that most people think of. It's most like Kickstarter, or where they would have done reward based. Companies can raise up to $5 million on a national basis from accredited or unaccredited. They have to go through a portal. The portal is licensed with FINRA and files the paperwork with the SEC. No, it's not an endorsement that company is investable. It's just that they file the proper paperwork. Okay. And they have to have milestones. They don't get the money unless they've hit a milestone. So investors' money is held in escrow until they hit that milestone. And then they split up the traditional Reg D into 506B, which is how companies still raise capital, and 506C, which is the investors have to prove that they're accredited. There's 3 ways that they do that, and it can raise unlimited amounts of money, general solicit, can run an ad on TV, whatever they want. And it's that particular one is kind of the wild, wild west right now in people raising capital that way, because it's a lot more not as defined, because the accredited investors are supposed to be smarter about investing than anybody else just because they have money. I don't necessarily agree with that, but yeah. And then you got Reg A plus, which is like the back door into going public. They have to file. They can raise up to $75 million from accredited or unaccredited, but they have to file SEC auditable financials, okay, to with the SEC. Also, not a validation that the company's good, but the fact that they typically have to have revenue, profit, all this stuff. They're doing something clever with it. You're getting ready to have exit. They've already raised capital. It's a little bit less risky in theory than like a startup, because you can look at their history. Investment bankers like them. Wall Street likes the Reg A plus. And then you have different states have offered up interstate exemption, and their rules vary by state. In Georgia, a company can raise up to $5 million from people in Georgia. And it's a really simple process in Georgia. So that's the categories, right? And so the SEC and the U.S. Treasury said there's not enough. There's, you factor all the other whatever's in there. There's about 1.5 million, let's say, investors. But there's over 20 million companies out there looking for capital that have 19 million of which have received some form of federal grant money through an agency to develop them, or funded venture capital or low interest loans that the government and nonprofits do to help bolster them. But we got what, $1.5 million, 2 million to 19 million? Big gap. And if this is where capital comes to build the companies that are going to start new industries or expand industries or create jobs, because the ripple effect when there's an innovation, things that we completely take for granted, but there's always a ripple effect of other companies that step into that new market and create other companies that support whatever that innovation is. It's where how our economy grows. And if that type of angel, that type of capital is the gap between bankable or VCable, we need more of it. And so why is that? Well, awareness, tools, and education was what they both found. People just don't know because it was a secret, hence why the books are called Inside Secrets to Angel Investing or Crowdfund Investing, because of the fact that it had been illegal for so long. So I mentioned 2012 with the Jobs Act, but prior to that, unless the entrepreneur knew the millionaires to raise capital or went through a broker dealer, they were really limited on who they could talk to about raising capital. They had to know them. And angel investors groups got through that because coming through the process established that kind of a thing. So if you didn't grow up in a community that around a lot of wealth, or go to a school that you got a lot of alumni brothers and sisters that are wealthy, MIT or Stanford, you just kind of you have limited access. And so people just weren't aware. And because of the rules about advising on it, financial planners and wealth managers were not allowed to advise on it unless it went through their broker dealer. So it created this false narrative about the risk of it, and nobody talks about it. There's not a buzz on it. You don't have anybody standing up at a Super Bowl thing saying, hey, go create an account on this, like they do with crypto. And you can't track it like you can and pull it up and do what's the rate of Bitcoin today, or this stock or that stock or whatever, right? And real estate had 20 years ahead of the curve on private investing to create tools and education and awareness of investing in real estate. And look at what's happened there. Now it's very inflated. It's harder to get into real estate. So awareness, tools, and education is the main limit as to why angels don't know about it, or people that have the ability to be an angel or ability to get started smaller and be a crowdfund investor. You can invest $100 a month, $500 a month, $100 a week, right? It's like when they were first looking at, I make this up, but I think it's really valid. And I think since I say I make it up, but I say it enough times, it still matters. It still can be out there. But, why limit? We don't limit people's ability to go buy a lottery ticket, right? A Mega Million or a Powerball every week or every day or every time there's a drawing, and spend whatever they want on it, or $500 a month on lottery tickets, or go to Vegas and spend $10,000 on the crap tables. We don't tell them they can't do that. Why do we tell them they're not allowed to invest in the entrepreneurs that are down the street or the next big thing that they are excited about? It's just why not? And so that's why I'm on this show, is to create awareness. Why I wrote the books, why I created the Compassionalist Academy, which is a digital on-demand platform for people to learn how to do this step by step, sensibly, to gain confidence and competence to be able to invest this way, whether they're starting out at crowdfunding or they're jumping in or growing as an angel investor.
Yeah, spot on, because we're bombarded with all these commercials and other ads for the online gaming options. Every online casino, everything is sponsored by some opportunity to gamble and bet. And not that investing is analogous to gambling, but if you're going to speculate, why not at least do it in an investment fashion where you've got an opportunity to get some upside?
Absolutely. And
Karen, we're getting close to the end here, but I want to give you the final word, and I'm going to give you 2 final words, if you're cool with that. Talking to the younger folks in the audience who are either hopeful founders or just curious investors, what would be your advice for them?
Youth. So I would say that the thing is that just do it. I mean, here's the thing. We have no idea what our futures hold. Que sera, sera. Whatever will be, will be. Here's the thing. If you're thinking, because a lot of times entrepreneurs, they get this thing, there's a theme, right? In order to create financial independence, you need to be a successful entrepreneur. That's the pathway to do this. in reality, it's really, really hard to be an entrepreneur. So the thing you got to do when you're becoming an entrepreneur, you can't just have a desire to be an entrepreneur. You have to have a real plan. And you need, the very first plan you have to have is it worth your time and your family's time and all the other stuff that you're going to do, right? And if you don't have a clear path and know how you're going to get the capital to actually do the things you're going to want to do, and a clear path that you're going to make more money than you can in a day job, then don't do it. Okay? Don't even bother. And we bought into this idea of side gigs and being an influencer and go sell books. Well, go create AI books and sell them on Amazon, which, that is not as easy as it sounds either. Everything has a challenge to it. So if you don't have a deep conviction that this is what you're going to do and that you're going to, put all this extra time, because you can never get your time back. You can get your money back, but you can't get your time back. But you can lose and learn and pivot and become better as young. As younger, everything is a learning process. You're learning life, and you can learn how to create wealth and financial independence by also investing in those entrepreneurs, the entrepreneurs that have figured out, that are extremely passionate about it. And so don't quit your day job in this day of needing, insurance, right? If you got insurance in your day job, and instead think about finding companies, set up your accounts on the various crowdfunding platforms, start looking at what's going on, be sensible about it. Part of the reason why I targeted this book towards millennials is because, and some of your audience may know Jason Kokonis, he wrote Wings of an Angel, came out about the same time that my first book came out. His book is more his story. My book is more of a how-to. But he's, he made his money on Uber and different things that he invested in early on. And so he's a real voice in the industry. And he was interviewing the original founder of Seed Invest, which is now Started, and said, and part of what he said hit home to me. He said, if I could go back and talk to my 20-something self when I first got out of college, I wouldn't have started that first business. I would have gone and gotten a regular job with a big tech company or some company, so I could learn how organizations work instead of failing trying to figure out how an organization works when I was first starting up. I would have just collected the paycheck. I would not have invested in their 401k because I wasn't going to get matched for 5 years and I didn't plan on being there for 5 years. But I would take this money, I would put in the 401k, $500 a month, and I would just put it into a Reg CF company that was just interesting to me. I wouldn't overthink it. I would just, but I would follow and learn which ones which ones succeeded, which ones had business. I would learn from all the business models that I had invested in, all the different technologies, all the different ideas that I invested with. And I do the math at the end of Inside Secrets to Crowdfund Investing. I do the math on this. And so this is what it comes out to be. If you do $5,000 a month in a 401k, right, for 5 years, then you're going to have $30,000 invested. And you just normal return without the matching funds on a 1K, around 9%, not counting fees and stuff like that, you're going to have about $36,000 at the end of that. Okay. If it just, accumulates like it does. And that's not for exact science. I didn't do a time value thing on this, right? But if you did this, so it's just really for example. So if you put that into companies, that would be 60 companies that you've invested in. And if we do the 10 formula that VCs usually follow, that says you're going to have one that does 10x, two that do X, two that do X, two that break even, and three go out of business. Okay, so just with that kind of thing, and you run the math on that. At the end of that, and of course, you're not getting that return right at the end of 5 years, but just, in the basis of that, right? Out of those 60 companies, you would have $78,000, a 10x. So six, because it's, six tens, so 6 10x, right? 12 5x, so on. Even with 18 companies that went out of business. Okay, so now Jane diversifies. So it gets better though over long term when you continue to do it. You diversify on stage and all the other kinds of stuff, which you can do on crowdfunding. But just as a math example, I want to inspire the next generation that says you don't have to find joy from your job, right? If you're not being, whatever. and go put your joy into helping creating a legacy because you've invested in a company that solves a problem and gets all the way through the gauntlet, and and to change the world in a way, and your little bit of money, however small or big it is, has a direct impact on that success. And so that's my message of inspiration. You can get the books on Amazon, and I think in the show notes I have my link tree that has my podcast, it's a bit.ly link, and it's LINC capital CCS for a Compassionate Capitalist Show. And it has all my social media, how to book a time with me if you're looking at deals and you want some help evaluating them, all that stuff, or you're trying to figure out how to raise capital. People come to me when they're tired of getting the no's and want more yeses.
How did you know I was going to ask you to tell the audience how they can find you?
I did. Yeah, I don't know. Maybe I've done this before on
There
both
you
sides
go.
of the table, right? So yeah, that's the way.
Exactly. Well, thanks for doing that. And this was a great conversation. The passion that you bring to this is evident, and you're doing a good mission here. So fun conversation and insightful as well. Thank you for joining us today, Karen. It was a real pleasure.
Thank you, Dave. Really appreciate being a guest on your show. It really means a lot. Thank you so much.
It was my pleasure. And thank you out there tuning in to Behind the Numbers. If you enjoyed the episode, as I always say, please leave us a review on Apple or Spotify. That stuff actually really does move the needle in helping people find the show. And don't forget, hit that subscribe button so you don't miss an episode. Until next time, I'm Dave Bookbinder, reminding you that the numbers tell the story, but the people bring it to life. Take care, gang.